Hello and good morning. We welcome you to Investing Master Series. My name is James Boyd. We welcome everyone here today. We also got Barbara Armstrong with us in the chat. Here we are on this Tuesday, March 10th. Yes, in Salt Lake City this week, it's going to be 70 degrees. On Saturday, I topped off my yard with a good old lawnmower. It's that time of year, so let's get going. So we welcome everyone here today. We got Amanda with us, Jim here, Dom, Richard, Lewis, and many others. Wiley, hello to you. Just real quick, I want to kind of talk about the topic of what I posted on my X, kind of looking at, is volatility a sign of technical bottoms? Now, we'll talk about that in terms of ATR, average true range. We'll talk about it in terms of ATR percentage, and then we'll also talk about it in terms of implied volatility. And are they telling us some similar things? So I got some examples and I want to talk through those here today. Now, just real quick as we get started, remember with what we discussed, we'll talk about stocks. We will also bring up options. Also understand that options are not all the same. They're different strategies, pros and cons of different strategies. So understand that. Remember though, that options carry a high level of risk, not suitable for all investors. When we talk about examples, the information that I give will be provided for general informational purposes only. Remember that investing involves risk. You should always be thinking, am I willing to take that risk? What is that risk, etc. And also remember when we talk about short options like cash secured puts, etc., that's an obligation. That obligation can turn into an assignment to buy the shares or to sell the shares. Buy the shares if you're doing a cash secured put. Sell the shares if you're actually doing a covered call. And those are American style options, meaning it's not just an expiration, it's from the time you do it up until expiration. So also remember with what we talk about here today, we'll talk about market conditions just very briefly. Then I want to kind of talk about kind of some of the volatility measures that I mentioned. And then I want to look at some new examples, some stock and option examples. Now, of course, as we do that, I'm going to be looking, the reason why I have two eyes is I'm going to be watching one eye. I'm going to be staring right at the camera, okay? The other eye, I'm going to look to the right and see if you have any questions as we go. So let's just kind of get to it. So first off, let me just bring up the SPX, the bigger picture. Now, remember, I mentioned on Friday, like when you have a market that goes down based off news, you can have the market rebound based on news. The market can go down or up based upon a bloody tweet or whatever platform it is, right? Kind of yesterday we saw that a little bit. Now, when we look at this chart, the S&P 500, 7,000 was the high. And if we kind of look at the drawdown from the top, okay, 7,000, and we went down to the lowest point of, let's say, 66 and change. So we fell down about 5%. Now, if you had $1,000 in your checking account goes down to $950, and you think it's the end of the world. Well, maybe not, okay? I mean, not much of a pullback if we're talking about the index. Now, individual stocks, yes, they could have gone down more, sure, okay? Now, when we look at where the index is, you're going to see that we're kind of right near that 30-week period moving average. Now, if you pull this up a little bit, that trend is actually still going, right? And if that's the weekly chart, pull this back actually just real quick to a daily chart, you're going to kind of see that if anything, okay, it kind of looks like we're just kind of more neutral-ish. The range that we've been having super quick, okay, that tighter range was probably 6,800 to 7,000. Not much volatility. That's super tight. And then it kind of broke open where maybe the bottom end, 65 and change, maybe 66.50. Nevertheless, it just kind of broke inside a bigger range. You're still in the, if we're talking about, let's say, weeks to months, a little bit more intermediate. On the S&P 500, a little bit more neutral. Remember, when you get the index doing this, you're really picking stocks for the most part, which stocks might go up more than the index or the sector and so on. Now, if we take a quick look at, let's say, the VIX. Now, remember, the other day we just went to 35, okay? So we went to 35. Let's go back to this chart. We went to 35 yesterday, and I made a comment yesterday, and trust me, I've thought through it. The higher that the VIX goes, the better. What do you mean? Well, the higher the VIX actually goes, the lower the prices go. Now, it's bad for the positions in the portfolio at that moment in time, but if you're looking to buy something, the higher that the VIX goes, maybe the better. Now, we've all been through a recession, right? You go through a bad recession, all of a sudden people have an RV that they don't need anymore, they say, and all of a sudden they're just willing to give it away. Well, how does it come to that point? Well, higher volatility, lower the prices. Same thing in the stock market. When people want to avoid pain, they're willing to just say, look, just give me anything. Just look, I know it was 100, just give me 90, okay? So when that volatility goes up, that is when you start to get peak state of opportunity. And a lot of people, they don't understand that. So the higher the VIX goes, the better. That does mean that if you own positions, you're thinking about, do you have protection in those things we talked about yesterday? Did you get out of the positions? How are you managing risk? What do you have? What's your allocation? Those things we said yesterday. Volatility sitting here at about 22. Now remember, crude oil, which has been kind of interesting to watch, right? 119 actually over on Sunday night. Here we are sitting at 84. I know the local gas station is going to say, well, the reason why our gas is up at 450 is we had to buy all gas at 119. Therefore, we have to pass on that cost to the consumer. That's probably what they're going to say, right? They're going to act like they bought everything at 119. I'm just waiting to hear it. Tell me what you find out in your local area. Crude, I mean, look, not the top, okay, but kind of maybe going back down a little bit. But still, just remember, you're one tweet away from kind of getting traders worried. If those tweets actually come out and they say, hey, the shipping lane is actually back up. I mean, with what happened yesterday and last night, those people that are trying to go long, it's almost like they're trying to get those investors not to go long and telegraph to market participants, this could be changing. So I think that's kind of putting some doubt in the mind of bulls to go long oil again. Okay, so just kind of keep that in mind. Now remember, when we actually look at, let's say that you can look at the interest rates, TNX, semicolon CGI, that's kind of holding in there. And the last one that I'll just make mention of is the US dollar. We call this the quad kind of products, that volatility, VIX, dollar, rates, and also crude oil. Those four, if those four are going up, the equity market highly likely is going down. And I'm not talking about going up over time. I'm talking about skyrocketing like they did. When you look at the dollar, we're seeing a little push down here. We would like to see an unwind, okay? We don't want to see this going up like this, okay? Get it to come back down a little bit. Now, I think it is also worth noting, okay? I like to look at, let's say, the US dollar is not the only thing out there. We got what's called the Japanese yen. I call this the international VIX. And you don't see internationally, if we're talking about using this as a proxy for fear, you don't see a whole lot of fear on this chart. The other fear gauge that I actually look at is what's called the Aussie yen, which hit a brand new high here today. And these are what's called yen cross pairs. If this chart's going up, if that yen chart is going down, this is why I haven't really been doing a whole lot of bearish positions, okay, in the portfolio. Those are holding down, and that other one is going up. There's not a whole lot of international fear. Now, I'm not saying they can't be selling and pushing the market down, but I'm talking about a bloody bear market, okay? Selling off 5% is different than a bear market. Let's just admit that. Now, the one thing we do have to say is when you look at, let's say, the NASDAQ first, kind of NASDAQ, tell me what you see here. The NASDAQ, if we looked at this, we've kind of had some pretty good green candles. Sitting right here at 24,560. Another one right in that range. Yesterday, a little bullish engulfing. Today, a little push. Now, remember, like old times, you guys remember, and gals, remember when the NASDAQ used to lead the market? Seems like 3 years ago. But seeing this actually go up is better because this is kind of what drug the market down, okay? Stocks, if we take a look at, let's say, semiconductors, better. price actually above the 10-period moving average now green, and above the 20-period moving average, that's better. Now, remember I kind of made the comment is that the higher the volatility goes, the potentially better the potential setup as far as the index, sector, industry group, maybe the stock. I want to kind of take a look at just real quick. Let's say if we were to use NVIDIA for just a second. Now, I want to use this one. We're going to look at this one first, and then I want to talk about the ATR percentage implied volatility. If we were to look and see the short-term resistance level, where is it? Short-term resistance level. Now, a lot of people say, well, I'll get in as soon as we break out of this range. But you got to remember, if the index is more neutral, the S&P 500 is more neutral, the NASDAQ has been more neutral, there's usually that little saying, buy low, sell high. Well, we don't have to wait for it to go up to the top. And could it really go up to 191 and try to play that little move? In choppier market conditions, these moves tend to be probably maybe 2 to 3 days on average. Okay. Now, what we're going to do, stock trade, is we're going to buy these shares, right click on the chart. Let's bring it up, NVIDIA. And what we're going to do is we're going to right click on it at the current price. So if I right click on the chart, right click, buy custom, I'm going to go with OCO bracket. Now this little ledge that we actually have, now is this a stock trade? Okay, it is a stock trade. We're going to use this area, this old resistance area, hopefully, okay? Could it stay above there? And we're going to take it less 2%. Now you might be looking for a bigger move. Me, I'm a pessimist. I can look through a keyhole with both eyes, okay, and see perfectly fine. Now, if we take a look at this, the stop, someone explain that to someone else if they didn't get it, okay? 78.82. Now, if we take a look at this 78.82, there it is. And that target, what I'm going to do is I'm going to use right about 194. Now, you might look at reward risk. I don't look at reward risk because it's all fabrication of what you think it's going to do. And you type in numbers that make you feel good, okay? That tells you nothing about probability, absolutely nothing. And also doesn't tell you about correlation either. If the SOX actually goes up, is NVIDIA correlated to the SOX? Could that influence the reward risk? Sure, okay? What we're going to do in this case is we're going to show the example of buying those shares. Now, let's say in this case, we're going to try to put $5,000 to work. $5,000 to work on, in this case, would be about 27-ish shares, okay? And if we did that, we're going to go confirm and send. Trade number one, we're going to send it. Now, that order is sitting right there. It's a stock trade. Now, what we're going to see in this case, there's the target, there's the stop. Remember, that stop is saying if we go down to that price or less, sell the shares of stock, okay? Now, okay, here we go. So trade number one is really looking at we looked at the SOX. Now, obviously, when we look at the semiconductors, that's the area that's above. A lot of bullish investors say, I want to get the prices back up above the moving averages, right? Well, it's one of the first areas that's done that. Matter of fact, if I pulled up and said, of the sectors in general, which ones are above, let's say, the 10-period moving average, and we'll double check this. I'm looking to see what column. I'm looking to see that 10-hole column. If we said which ones are above, or I should say, which ones in the rows have the price above the 10 and or with the moving average is green. There's three, okay? Which SOX and technology go together. IYT, IXT is at the top. SOX is actually second from the bottom. And that other one is gold, okay? Now, someone mentioned on my X page, well, it's such a weird market. Why is gold going up when the market goes up? Well, listen to what we said. Like, some people buy consumer staples because they want companies that pay dividends and more consistent revenues, things like that. But some people look at precious metals as a consumer staple. Okay. Maybe it's also like a old historic form of cash. It's also something that has more inverse correlation. Not 100%, but sometimes you can also get it that so think about something. When you buy stuff, when you have money in your pocket, you tend to just want to buy stuff that is going what? Up. Something that might bring you joy and happiness and peace and the whole 9 yards. People don't typically care what it is. If they see it going up, they're like, man, I just want to put my money in something that could be going up. And gold does have some inverse correlation, sure. But also, it's not completely benign to what the stock market does. If people are more in a mood to buy something, they want to buy something that's going up, whether the stock is ABC, DEF, GHI, whatever is X, Y, Z, or gold itself, they're going to try to look for those trends. Does that make sense? That's technical analysis, okay? Now, if we pull up this chart, if we pulled up GC itself, the gold futures. Now, the reason why we look at the futures is we want to look at the actual price of gold. We're not trading gold, but we're looking to see what is the price doing. And the biggest actually thing is how that relates to the companies that are selling the product, okay? So a company like Rio Tinto, example given, their sales, their profitability of the company, et cetera, is based upon these prices, okay? It's not based upon soap, okay? It's based upon how, when they get the product and they go sell it to the market, what prices are they getting? This gives us an idea of what the backdrop is of the product prices. Now, the company makes a forecast of what they think those prices might be. However, things can change. And if those prices go up, it leads the investor to think that their forecast could maybe be too low, okay? Now, if we looked at GC and said, 128, 2.5% in the shorter term, we broke down. In the last 4 days, we've been kind of sitting in the bottom of the range. Big fat red candle kind of being an area of resistance here. And what you're now going to notice is if we can kind of get above that, you pretty much have this. Just a couple days ago, it looked like gold was running off to the upside, and then gold got pushed down. It got pushed down, not as bad as other things, but it did actually have that drop. Remember that US dollar gold relationship, right? Gold goes up like a teeter-totter, one goes up. The other one might go down. Now, if we see the opposite, US dollar go down, could people be trading that correlation? Yes. Okay. Now, if we looked at, let's say, we're not trading this. Let's say the investor says, I want to go look at a stock that might be starting to bounce. Now, one of the most oldest plays in the book is like buying in a pullback to a horizontal diagonal support level. Look at me, okay? This is your classic example. People always say, I'm waiting for a pullback. But when it pulls back, that means that the volatility went up. And when the volatility goes up, people's heads go down and they're not paying attention. Then all of a sudden they start to pay attention when the price goes back up to the prior high. And then they say comments like, geez, I wish I would have bought the pullback. Well, you weren't paying attention, okay? So you have to understand something. When that volatility goes up, that is when you watch the most. Now, I've done this for 25 years. I've been at this company for almost 25 years. And what I've found is when there's a lesser amount of people attending class in a volatility type of event, it tells me something that people mentally have checked out. And when I see that, that kind of says, hey, the volatility is affecting them mentally and they're not paying attention. And by the way, it's not just in this, it's in other areas as well. The biggest actually thing is just always keep in mind when people kind of mentally check out, that's when you could be trading near those lows. When other people mentally throw in the towel. You know, that's kind of an interesting potential point. Don't forget that. There is some trading psychology to this. Now, I'm going to go back. Now, the question is, how far do you go back? Well, if we look at this low right there, I'm going to kind of come back a little bit. I'm going to say, well, how many of these lows can I touch? I can touch there. I can touch there. I can touch that. I got 1, 2, 3 spots right there. Oh, look, I can touch that one. So the question is, well, how far do you go back? As far as we can. But if I said just for this moment, do we have a couple touches here? Yeah, we sure do. Now, the investor might say, well, now let me ask you a question. I mean, you've had experience too. What would you say, like if you get the price to come down to the area of horizontal diagonal support, what would you say for yourself would be like, that's my entry? Like, what is it? Can you explain it? Now, as I'm getting some answers, and type in the chat. So here's the deal. If the investor said, you know what, James, I look for the price to come down. I'm looking for some green candles near that support area. Okay, now here's the problem. If you get some green candles, that it could be just spinning tops, dojis. That doesn't do a whole lot for some investors. A bunch of green candles. I want green candles, the investor says, getting above where that last red candle was. The lowest, most recent red candle is really right here, right there. So the investor is going to mark that. So that's kind of the last dagger that those bears knock that price down with. Some investors are going to say, look, I want to see that the bulls make a stand. And they start to knock that price higher, trading above that high, closing above that high, and lo and behold, here he goes. Now, it's not that the investor doesn't have the setup. What it really now comes down to is, are they willing to take the entry? Okay? So remember, if we said, hey, in the portfolio, we're willing to risk $5,000, we're willing to invest $5,000, we're willing to risk maybe 1% of the portfolio value, we're now going to ask, are we willing to do that? Do we have capital to do that? Well, if I went back to AEM for just a second and I said, okay, I'm going to choose a stock trade. Now, why a stock trade? Well, if the investor said, look, I want to try to use some of that cash, hello, right? 33,000 of the 39,000 is sitting on a big, fat, puffy pillow. This is when the investor is trying to reallocate back to strategies that are more capital intensive, have a higher delta, and they're trying to use the capital. Now, what we're going to do is I'm going to right click on this chart, buy custom with OCO bracket. Now, whenever we see this, the fallacy is, oh yeah, I'm going to target this prior high, and that's all there is. It's called a high for a reason, okay? That's the prior high. That's what's called potential resistance. Why do you call it potential resistance? Because if you made a high, it hasn't retested that. To really get good levels of resistance, you probably need about, if you make a high, you probably need about another 2 weeks to see if it can go back up to that area and then retest it again. Okay? Now, if we take a look at this, I'm going to put the prior high as a target. Speaking of target, I want to get to target. But the biggest actually thing is if you look at 252, we're going to go dated GTC. Now, is it saying that that's all? No, the investor might say, I'm going to set an extension target. I'm not going to do that. I'm going to try to take something that's a little bit more probable that it could do that. No, of course. Of course. If someone's long anything precious metal, of course they would actually be looking at the gold price, okay? Because they understand how the business is making money, okay? Now, if we take a look at this, it moves to the upside. If it got the extension, 266, okay? But I'm going to put 252. But I mentioned that line if you said I want to put the target extension. Now, if we look at underneath, that recent area was, let's say, 216. That's yesterday's open price. If we said, James, I really want to take the moving average, thinking that it's a little bit higher, try to actually see if we can't bounce on that level, it's really 220. That's really the closest we would take it right now. Again, in our examples, we're not trying to set super tight stops. We're trying to actually get those trends to move and give them room to move around. 216.05. Now, if we look at this 216.05, we want to now be asking ourselves, geez, is that too tight? Well, if we go back and look at this 230 and 216, there's a tool called ATR. If we go forward to really, let me go back to that. If we go back to the tool, of this chart right here. So remember on our example that I posted yesterday on X. Now, if you're not on X, follow Barbara and myself on X. We post educational examples and also some other tools as well. Now, the biggest actually thing is ATR, that's expressed in a dollar term, like I said yesterday. Now, I want to kind of talk about kind of some of the differences of why the ATR might be insufficient. Now, I'm going to show you 3 examples, okay? When you look at a stock that's going to the upside, ATR is looking at the dollar movement on average, low to high, average, range, over the last 14 days. So when the stock price is going up, the stock price is higher, the range is higher, and that ATR is a good barometer to kind of say, look, if we get in and we set our stop $4 down, the stock moves $10. So if we had risk less than what the ATR was, the chances of getting stomped out are extremely high. Okay? It's like saying I put $400 in my checking account, but I normally will need about $1,000 in the month just to pay basic bills. So if I have less than what I typically blow through each month just to pay bills, the chances of going negative are extremely high. It's the same idea. Now, if we take a look at this, so we just want to make sure what range are we actually setting the stop? 213, 216. We're about $14. We're 1 ATR plus on the outside of that, but we wouldn't go any closer than $10. Okay, else we're just kind of setting ourselves up at that point, and we're kind of like not fully understanding what that is showing. Now, 230, 252 target, stop 216.05. Going to go to confirm and send. And now what I'm going to do is, now remember the stop is saying if we go down to that price or less, sell. Now what I'm going to do in this case is let's go look at some examples using the ATR percentage, and implied volatility. Now for me, I think the ATR percentage, by the way, the ATR percentage is the ATR dividing back into the current stock price. So it's expressed as a percentage. And so let me show you just real quick. I'm going to look at some examples like AMAT. Now, this is the perfect example why I historically, probably 20 years ago, said I hate ATR, because the ATR isn't not very helpful for what I'm looking for, bottoms. ATRs, the dollar ATR is really useful for traders who are looking to set stops, but that's not what I'm looking at ATR for, per se. Because usually I'm not setting the stops that tight, okay, as you've seen in many examples. Now, the ATR percentage is very similar to implied volatility. Now, ATR percentage is looking at the stock volatility. It's the ATR, dollar amount, divided by the stock price, expressed in a percent. The 20 is 2%. The 40 is 4%. The 60 is 6% movement of the stock price. So as you would kind of think, the ATR percentage looking at the stock volatility. Now, if we kind of looked at this and said, where's the low? I think many investors would say, James, the kind of the low of this kind of looks like 20. If that stock was moving, let's say 2% or so, okay, that's like low volatility for the stock. If we kind of said, well, where's the medium range here? Well, the medium range is kind of maybe right around 40. 40 is also known as 4%. And if we got some high volatility, man, we're probably up at like, let's say, right near probably 60 or 6%. Now, notice that if you looked at the ATR percentage and you looked at the implied volatility, it's pretty similar. When I said example 1, Low volatility on the stock was like implied volatility of, let's say, I don't know, probably 35%. If I said number two, ATR percent, maybe 4%, you're now going to see the implied volatility was probably right about, if I could draw a straight line, probably right around 50% IV. And if we actually said that third line, upper line, high volatility, people throwing in the towel, saying, uncle, mama, okay, just saying, look, I can't take any more pain. All of a sudden, you're now going to, by the way, I've been there. I've said uncle a couple times when I was first getting started. I was like, my gosh, I didn't set a stop, and I swear, I swear next time I'll position size. Okay, it's funny when I look back on it, but it wasn't funny at the moment. Okay, now if we take a look at this, that ATR percentage, the implied volatility, very close. If you are using options, you might say, I'm going to use the implied volatility. If you said, I'm a stock investor, why would I use ATR percentage? It's simple. Because when you look at upward trending stocks, that ATR is hard to get a comparison, because as the stock goes up higher and higher, the dollar amount of the ATR is going up higher and higher. And how do you compare something to that, like looking for bottoms? When I'm looking at ATR percentage or implied volatility, whether I'm trading stocks or trading options, that trader, whoever it is, they're actually saying, I'm looking for the ATR percentage to be in the upper zone or range, and that implied volatility, if you use options, to be in the upper zone or range. That's probably telling you it's a great means for comparison. Now, what I'm going to do is I'm just going to quickly show you now, by the way, AMAT, if we looked at this and said, is AMAT kind of in that upper zone? You better believe it is. If you look at the implied volatility of AMAT, is maybe that in the last 2-3 days has been in the upper end of that implied volatility? Yeah. Okay. Now let me show you just real quick two more. Okay. GLW. Okay. Now remember, as his stock went to the upside, right? The dollar amount of the stock became higher and higher. And you're going to see just over time, the ATR has gone up higher and higher as the stock went up higher and higher. So hard to compare. However, when you look at this last, let's say, this last pullback that we had, and that last big pullback was, let's say, April. Now, I know what happened, right? Last pullback in April, the volatility goes up higher and higher. As investors, we become scared. But remember, the higher the VIX goes, the more interesting the entry potentially could be. Now, the ATR percentage got up right around 60, or also known as 60%. What makes the ATR percentage interesting is it's looking at the percentage movement. And if you look in the last couple of days, we've actually even got slightly above 60. Okay? So for stock traders, we're like, wow, we don't normally get that much volatility. The higher the volatility, you could be chiseling and carving out those bottoms. Yeah, but I talked to my friend, and he said he's nervous about the stock market. Look, feelings. What are feelings? Feelings, like, what is that? What are those? What do they even do? Okay? We're not talking about feelings. We're looking at data. Now, if we take a look at this, you're going to also see when we were high, if you said, I trade options, we had high volatility right there. And all of a sudden, here we are again. Now, I know what we're asking. We're saying, well, do you think it's going to bounce? That's the question, right? Do you think it's going to bounce? The answer is, we have not an earthly idea. We're going to go back to what we actually focus on, which is how much are you willing to risk, and say what type of strategy might be more conducive to high volatility. Now, if we said the volatility was high, I'm going to buy a call. Well, you could. It just had to pay more for it. And the more you pay for it, the higher it actually go to break even. Well, the investor might say, well, geez, maybe I don't want to do that. Okay. Maybe I want to kind of do something where I try to collect that time decay and try to get the implied volatility to go down. Now, James, why are you so passionate about this today? I just feel like you're just all into this today. It's because if I went back to myself in 1996 and had a discussion with myself, I would say, like, you're looking for opportunity, and it's when the volatility is the highest. That is when it is, typically. And so does it mean that all trades are going to work? No. If you pick individual stocks, they might not work at all. The investor typically trades a product that is more index-based, something that tracks an index, something that tracks a sector, something that tracks an industry group. That tends to be a higher probability trade. But if you start to pick individual stocks, the investor better get that stock movement because this stock might underperform what the industry does, the sector does, and the stock market. Okay, so we understand that. So if we pick an individual stock, you are now being a stock picker. You are saying, I think this one is going to do maybe well, be in line with the industry group, sector, index, and so on. Time will tell, right? Now, what I'm going to do is, let's say the investor says, I want to try to sell something. Now, by the way, if you don't have this chart and you say, I'm not on X, let me send that to you right now, okay? Now, if we pull this up, okay? So if the investor said, James, that volatility is a little higher. Now, by the way, if we went back to this and said, could we maybe draw a little diagonal line here, okay? If we were to draw a diagonal line, are we kind of maybe getting like a line of support, okay? Now, sometimes those prices can go below that support level, like it did, okay, from what I have drawn. And if we look at yesterday, piercing line candle. Today, a little gap to the upside, okay? Now, obviously, the investor, they might say, it got above the 10-period moving average. I want to see a higher low. Well, that higher low, you want the price, of course, to probably stay above 128 and change or so. Now, what I'm going to do on this example is if the investor says, I want to sell something, but I want to have some downside protection. Well, that's a short put vertical. If we said we want to sell something, we're going to go to GLW. And if we pull this up, you're going to see that not all strikes are equally liquid. Example given, the 135, not that liquid, 85 cents wide. Now, by the way, in the last, let's say, couple days, when you look at when the VIX is high, there's a lot of products, I should say a lot of stocks, that have high stock volume, but the option liquidity, the option bid-ask spread is wider than normal. How many of you, understanding that the VIX is higher, the implied volatility is going to be higher, and the spread is probably going to be higher? We get it. We talked about that. We're going to right-click on that 130. We're going to sell, and if we said, well, could we do a $5 wide spread or a $10 wide spread? The answer is, what could you risk? If we said I could risk $900, example given, well, we could do, in this case, if I did the $5 wide spread, well, if I did $900 worth of risk, hypothetically, if we could take that, it would be about 3 contracts if we kind of round it up. If we said, well, why would I do 3 contracts and just do multiple commissions when I could maybe consider doing the 120? Now, we cannot assume that we want to verify what's the spread on the 120. Just because they have it doesn't mean it's maybe fair. Are there people that are trading that activity on it, like volume today, open interest, etc.? And that's relating into the bid-ask spread. So in this example, we're going to look at selling the 130 and the 120. Okay? Now, you're now going to notice if we go confirm and send, you're going to see that there's the order right there. The 130, 120, and there you actually got that commission. Now, remember, this trade has a built-in max loss. Now, this is very important because if this bounce does not hold, given this trade, it can only get so bad, given the vertical, okay? Now, if we take a look at this, maximum profit, maximum loss, and of course, whenever the maximum profit is less than the maximum loss, it's a probability type trade. And notice the break even is not saying break even today. This is break even at the expiration. I'm going to go ahead and send that order. Now, what I'm going to do is let me kind of just take a quick look around, okay? So what I want you to do is, for homework, okay, I want you to, on this chart of the ATR percent, and implied volatility, I want you to really study over AMAT look at the pullbacks and look at the differences. Okay? AMAT will be our example number 1. The GLW will be example number 2. And the third one will be keys. Okay? Example number 3. And I want you to look at, if you said, James, I am more like, so the ATR percentage becomes more important if you're getting more of an upward trend, because the ATR is just showing higher dollar movement. The ATR would be more helpful if you were in a more sideways type movement, like as of recently. There, you're not going to see as much difference on the ATR versus ATR percentage because the trend is sideways. Okay, so 3 stocks, AMAT, GLW, keys. Now, the other thing is I want you to keep an eye on is stocks like example given. If we pulled up, let's say, a stock like Avgo, one of the other stocks that's kind of like Avgo that's trying to get a little push to the upside is Avgo. Keep an eye on that. That's post the earnings. That is almost to a short-term 20-day high. Keep an eye on that. The other stock that we've actually talked about, could it be making a higher low, is Amazon. It got above the 210, had a little hammer-like candle. Okay? You always like that tail longer. But the biggest actually thing trying to get that higher low on Amazon. The other one to kind of keep an eye on is also looking at Starbucks. And if you look at Starbucks, that's kind of the one that's kind of grinding a little bit to the upside. Could that actually start to break out? Okay. Now we got Cameron May coming up at the top of the hour. Barbara Armstrong normally teaches getting started with technical analysis. I'm normally the chat person. I am going to take, well, she has allowed me, okay, to take the position and teach getting started with technical analysis here today. And that'll be the absolute pleasure. So Barbara and I'll teach the getting started with technical analysis that Barbara normally teaches. She will be in the chat. So the Canadian and the New Yorker will actually be working together again coming up later on. So just want to give you a heads up on that since Barbara's with us. And also remember that Cameron will be coming up right at the top of the hour. Now remember, if we take a quick look, just kind of where the market is here today, you know, you got to remember is, like I said before, you're one tweet away from, and I think the tweets yesterday were kind of trying to get those bears to come off those positions. I could go into that, but keep an eye on this, right? If we continue to see the NASDAQ get a little push or lead to the upside, including with that, the semiconductors, some investors might be using this and saying, look, news sometimes doesn't always hold, and they might be going back into some of these areas that they were looking at before. Keep an eye on gold, keep an eye on silver, among other things, copper included. It's not a recommendation, but some things that some investors might look at. Now, remember with what we discussed, it was done, for example, illustrative purposes only. We had a lively discussion on how maybe to relook at volatility. And could volatility be the opportunity that the investor might be looking for if they actually looked at the price chart? Okay. Now, also remember with what we talked about, all investing involves risk. And this has been the class on the Investment Master Series with a focus on ATR percentage, and implied volatility. Thanks so much. Stay tuned for Cameron May coming up next. And thanks to Barb and to all of you. Take care. Bye-bye.